Hello traders, Captain Safai here from Algo Tradingo. In this video, we want to speak about CFD or contract for difference market. Actually, the CFD market is the mirror of the preliminary market, and it has the same feature but with a little change in the regulation. First of all, there is no asset or physical delivery here. For example, if you buy any share in trade station and after that you have the ownership of that share. But if you buy Apple in the CFD manner, for example, in another broker that provide for you the CFD of that stock, when you buy anything or that asset, you are not the owner of the asset. You just paid or make profit or make loss based on the difference of the price of that asset in the future. The trader expects the price of the asset to rise or fall based on the long or short position that we will discuss about short position in the next video. The trade is done through broker. This means that there has to be a brokerage between the traders to trade with their money. And if the price rises, for example, you will get profit. And if the price falls, then you will lose if you be in the long trade. Let's explain it to you with an example. Consider that there are two persons with the name of A and B, which they are in the trade session and they work on the first market. For example, if there is a share with $100 price for each share, and the person B have this share and the person A thinks that the price of this share will rise and the person B thinks that the price will drop, so this one wants to sell and this one wants to buy this share. So if the person A buys the share from person B, the ownership of that will deliver to the person A, and the person A will receive dividend for that or any other legal item. But if you consider person C and person D, in the brokerage like Alpari or other brokerage, and the person C thinks like the person A and he thinks the price of this share will rise, and the person D thinks like the person B and thinks that the price will drop. So if C buys from D, there is no ownership that delivered to him. The person C will not paid by dividend or other things, other legal items. The person C just received payment if the price goes higher. For example, if the price goes to $120, both person A and C will receive $20 profit, and person A also will have dividend at that moment. And both person D and B lose $20 because if the person B, he or she hold the share, he or she can get more money for that. Or person D, if he hold that, or if the person D won't be in the short sell position, which we discussed in the next video, he will not lose any money. And in the converse, if price drop to $80, in this situation, both person A and C will lose $20 of their money, and both person B and D will get $20 profit. So the difference between the price will pay to the people which trade in the CFD market. And also there is a brokerage between the traders, and also there are leverage. That's the big killer in the market involved in this area. And in the CFD market, you can use leverage. Actually, you have to choose some leverage from the brokerage area. So it is the CFD market, and like the stock, commodity market has CFD too as well. And you have to know that the CFD is the mirror of the first market.